Hello and thanks for joining us today on the BarthCalderon Boss Series. Today we're going to talk about cutting taxes. My name is Bill Black. I am a business planner, have been since the 1980s, certified exit planner, and I've also hosted a radio show called Exit Coach Radio over the last several years where I've interviewed over 1,000 advisors. We started this series, the Boss Series, after we've talked to over 500 CEO peer groups representing over 5,000 CEOs. We've collected a series of common issues that we've heard from business owners. We know that business owners like you are so busy working in your business, you don't have time to work on your business, so we wanted to help you and our other clients take more control and become better business owners. So today we're going to talk about cutting taxes briefly. You know, taxes are a significant area of planning, and they show up in many different ways: income taxes, capital gains taxes, estate taxes, or death taxes. We're always talking about taxes, it seems like, and many decisions are made based on the impact of those taxes on the decision. And there are several strategies that help business owners reduce or minimize taxes, and we're going to touch on some of these. Now, I want to tell you first up front that we're not providing this as tax advice. That's up to your CPA. We're simply giving you an overview of some of the common concepts we see out there so that you can be more well-versed about them and talk about them with your CPA. So let's talk about reducing taxes on income. We all know that there are certain types of plans called qualified retirement plans. Those encompass things like 401ks and profit sharing and defined benefit. However, it's surprising to me how many business owners I talk with who don't take full advantage of this for themselves. They see them as an employee benefit, or maybe they think that, you know what, several years ago we had a defined benefit plan, but it was too much red tape and too much reporting, and I don't do it anymore. Well, this is something you should talk to with your benefits advisor, especially if you're under 50 employees and you have a set of employees that are lower paid and you're the highest paid and oldest employee on your payroll. You might be surprised at how much you can put into these plans or put into on your behalf from your company that is usually a much lower tax hit than you taking the distributions themselves. Most people I talk to, they feel like when they take distributions from their S corporations or their other companies, that they get hit about 50%. Sometimes when the stars line up, you can get as much as 80% of a dollar that's contributed to a pension plan to hit your account and your statement. So it's very important to take a look at qualified plans. They're very mainstream, and it's right out in the open. It's something you can look at. And if you haven't looked at that in a while, then it might make sense to take a look at that. Let's talk about reducing taxes on the sale of your company. There are several strategies depending on the structure of your sale. If you're focusing on an outsider sale, you're going to sell your business to an outside buyer, you're going to be faced with a decision based on probably your buyer. They're going to want to buy your assets of your business most likely as opposed to the stock of your business. You're going to want them to buy your stock because you'll get capital gains treatment. But most of the time buyers want to buy assets because they're not buying your liabilities that come along with the stock, and they're getting to redepreciate assets that they buy. Sellers, I guess, as I said, want to sell stock because they can get capital gains treatment. And typically we'll find that the goals collide and it gets all worked out in how the business is valued, and there are adjustments made to it. But you need to be aware, if you're selling to an outside buyer, you're likely going to be asked to sell assets, not stock. And to prepare for that, you're much better off, if you're currently a C corporation, you're much better off having converted to an S corporation at least 5 years in advance of that sale. You could avoid a whole layer of taxes, meaning if you sell assets as a C corporation, you can end up paying 2 taxes on that transaction. One on the internal basis as the company sells the assets and pays a capital gains on that growth, and the other on a stock sale as the company liquidates and sells to you. You can end up paying 2 layers of taxes on a C Corp, where if you convert to an S Corp 5 years in advance of that sale, you can avoid a whole layer of taxes. And again, this is something you should talk to your tax professional about. ask them about that if you're a C corporation, and frame it in such a way that you say, look, I'm thinking about selling my company in the next 6 years or so. Should I be converting to an S corporation now? And a lot of times if you ask in that way, they'll tell you, yes, you should, based on that knowledge. A lot of times they won't tell you to convert to an S corp based on an ongoing year-by-year tax analysis. So you need to frame it properly. Let's talk about insider sales strategies. Let's talk about one called an ESOP. An employee stock ownership plan is a plan where you actually sell the company, so you sell your stock to a profit sharing plan, and that profit sharing plan buys you out of your stock, and it receives the money to do that from contributions that your company makes to the profit sharing plan on a tax deductible basis. I know I just said a mouthful there, but if you think of it like you're selling your business to a profit sharing plan, and then the company is making tax deductible contributions to that plan to buy you out, you'll get the gist of the way an ESOP works. If you are a C corporation and you want to sell your company to all employees, this is one of those situations where you should not probably convert to an S corporation in advance, because you can have even more tax advantages when you receive the proceeds from the sale of that stock. So again, it's a complicated area. It's one you want to talk about to your with your CPA if you're thinking about selling your company to insiders like your employees. Now, ESOPs are where you sell to basically all of your employees who are eligible, and that's people that have been with you for at least a year or are over age 21, and there are some tremendous tax benefits if the stars line up right. So it's something that you should probably think about and talk about and get an analysis done before you pull the trigger on. A lot of people tell us, you know what, that's great, but I don't want to sell it to all my employees. I just want to sell it to a few key employees. And in that case, we recommend that you start as soon as possible to help your key employees build up a balance to buy you out. And you do that through something called deferred compensation. The idea is that if you think of a normal sales situation, your key employee usually doesn't have any money, so they get money from the company. And so in a typical installment sale, the employer pays a bonus to the employee who pays tax on that bonus. And then the employee turns around and buys stock from the owner who pays another tax, usually capital gains tax, on that sale. So the money that the company's generating, the cash flow, gets taxed twice. It's a very inefficient situation. So it's better if we can have the company pay the seller mostly by deferred compensation and reduce the sale price, reduce the double tax sale price by having that compensation paid directly from the company to the owner. Now what happens there is we develop a plan that says, you know, there were years that the owner was underpaid, and we're going to make up for that when the owner retires, and we're going to call it deferred compensation, and basically save a whole layer of taxes potentially over the installment plan I talked about just a few seconds ago. The other thing that we find is that a deferred compensation plan can work to help your employees take on more work and pay them in such a way that they don't get the compensation currently, but they get it in the future at some particular time or event. And that can help your employees save up a balance to buy into your company, a down payment, for instance. And again, the concept is the employees are told you're going to take some work off of the owner, you're going to start working more like the owner, and for that you're going to get paid in a way that's deferred or somehow restricted, so you don't get to access that money. The key is to make sure that it doesn't hit their checking account until it absolutely needs to, and at which point they're going to turn around and buy the business from you. The problem is, of course, you pay bonuses and other things that are unrestricted, and they spend the money before you get to the event where they're able to buy into your company. So there are several strategies that come into play there. And again, we're just touching and scratching the surface on a lot of tax strategies, but there are several of these tax strategies you should be aware of as you think about your business and how to minimize the taxes. We do also offer a free value builder assessment here at BarthCalderon. All you have to do is go to a website we set up specifically for that. It's called bizgrowth123.com. The address is on your screen right now, bizgrowth123.com. and you can take a 15-minute assessment. There's no cost or obligation. You'll receive a free report you can use to grow your business, and it can help us to start a conversation with you about how to build a more sustainable, valuable business so that you can either sell it for more someday or transfer it effectively. And of course, that starts us kind of understanding more about your business and helping you understand more about your business so that we can have a better discussion and work towards reducing taxes, building value, getting you what you need out of your business. This Boss series is a series of short videos that we put together to help you tackle top issues. We have new content every week. Next week we're going to talk about protecting your assets. I want to thank you for joining us here at BarthCalderon today. On behalf of the firm, my name is Bill Black, wishing you continued success as you plan today for all of your tomorrows.